Welcome back to Click Capital, your go-to channel for all the latest market data, analysis and charts. So we had a bit of a turnaround today. Actually saw healthcare and utilities and consumer defensive pop, and we had the financials and a bit of cyclical, and the semis actually came off. The semis were the worst performing sector today. So that's been a big turnaround of what's been the theme this year. So stay tuned into this video and I'll go through all that on the charts later on. Moving over to economic data today, a little bit mixed. We had durable goods orders coming in a bit worse than expected, but PMI is coming in a little bit better than expected. So global services still in an expansion mode, they're above 50, but manufacturing just slightly in contracting territory there at 49.3. Fear and greed index just ticked down 1 point from yesterday, so not really much happening in the markets there. It was kind of a bit of a flat Friday actually, and we saw that in the options market. Tesla couldn't even crack 1 million contracts today. We've still got Nvidia being really highly traded, but again 58% puts, 1.4 put call ratio. So I've got a feeling a lot of people are piling into puts here and shorting it. We can all see that it's really overvalued, but that could lead for a squeeze up to 300. I mean, there's still a lot of momentum in the price, but we did have some interesting price action in semis today that the puts might actually like, and semis was actually the worst performing sector today, so that was really interesting, and we could be at a turning point here, but it's still too early to say. Another one that made it up there today was Deutsche Bank. People are worried this could go the same way as Credit Suisse, Germany's largest bank, which we'll get into. 78% in put activity. Over to the dark pools, that actually bumped up a bit today, 51%, so that's bullish. So the dark pools have been doing a little bit of buying of this dip, but corporate insiders haven't been. They actually came off yesterday, only 52 purchases, and sales still relatively elevated, but they've come off a bit this month as well. So corporate insiders are kind of dialing down their activity. Over to Fed Fund futures probabilities, that's jumped again today. We're now 83% chance of a pause in May, 16% chance of a 25 basis point hike. So there's a big divergence in the bond market and what the Fed speakers are saying, which I'll get to in a bit as well. And one of our loyal followers pointed out to me yesterday that copper supplies are really low, and I found this chart today. It's actually trending really down here. We can see in the blue line 2023 is forecast to have stockpiles depleted by August if the present trend continues. So that's going to change the way we look at copper as a forecasting indicator of economic growth, because supply and demand overwhelms everything else. So we'll keep that in mind. And Germany's largest bank, Deutsche Bank, looks to be in trouble. Investors are worried, and every right to be, with central banks and the Feds not bailing out equity and bond investors, only deposits. So this thing is sliding down, and unfortunately just got the kiss of death from Jim Cramer as well, a great short signal. He actually came out today and said Deutsche Bank is okay, don't worry about it. Unfortunately, he said the same thing about Credit Suisse not too long ago, and that just got blown to bits. So he's done it before too, with Silicon Valley Bank and Signature and Crease. So it looks like Deutsche Bank could be next. And still no word from Warren Buffett. Doesn't look like he's stepping into the banking sector, and doesn't look like he's saying much. He holds a lot of bank stocks, so he probably doesn't, if he's got some bad thoughts about it, he's probably not going to come out there and say it. He's gone real quiet, which I don't think is a good signal for the sector. Because if there's one guy that knows banking stocks, it's Warren Buffett. And if this was a real opportunity, you think we'd hear him stepping in and doing something. Still might happen, but so far, haven't heard anything. Bond King Jeffrey Gunlock joins Powell as Ron Chorus predicting rate cuts. So he's with the bond market here, which is predicting that they're going to, cut in a couple of months down to 4% in December. And he's saying the Fed's got it wrong big time. So we're seeing this huge divergence, which I'll show you on the charts in a bit. Short sellers step up bets against office owners on bank turmoil. So the commercial office sector is in big trouble, has been for a while. This whole work from home thing, we've seen occupancy rates go down, their rents go down, and they've got a whole bunch of debt maturing this year, which is going to get rescaled up at a higher rate, and regionals are the biggest supplier of debt to these guys. So the whole thing is in a complete mess now for commercial real estate, and this adds more problems for the regional smaller banks too that have lent to them carrying these assets on their books. And wouldn't you know it, old hawkish Jim Bullard hasn't changed. He's actually increased his outlook for rates now. He's got a target of 5.62. Now we've got Fed Fund Futures Market saying December there's going to be 4%. So that's a 1.62% spread on him. And he's saying there's an 80% chance that financial stress abates. He doesn't see a problem. He thinks it's all strong and good. But of course, he has to come out and say that. As a Fed speaker, he's not going to come out and say things are turning to hell. And he still wants to keep the foot on the gas on inflation and hiking rates. Retail traders plowed more than 200 million to regional bank stocks over the last week, and they've actually picked up their flows overall into equities. And out of that 200 million, they've put in 110 million into First Republic, 36 into PacWest and Western Alliance. So these are really risky bets. If you're one of them, I wish you luck, but I'm not sure whether these are actually going to survive or just turn into zombies. Technically speaking, they look dead to me. I mean, they still could do a dead cat bounce, but whether they get back to previous levels a month ago, I'm not so sure about that, because they are still facing a run on deposits, and with all the other mess in commercial real estate and rates going up still with their treasuries, it's still a lot of mess to get through there. And they're sitting on 1.7 trillion in unrealized losses. So that's a huge, big mark-to-market thing that the Fed and everything's going to have to bail out, and could potentially still turn a couple more banks into zombies. And the most vulnerable banks have lost 1 trillion deposits in a year. So, and they lost about half of that in March, just this month alone, from Silicon Valley Bank. So that's a kind of a run on the smaller side of the system, with all the big ones, getting more deposits. So the top four actually getting more deposits from them. And now Treasury bills popularity is booming. Anyone can just go to treasurydirect.gov or through their broker or bank, and your money's safe when you lend it directly to the government. So the whole small regional banking sector has got 99 problems, that's for sure. Okay, over to the charts today. So pretty green across the board there today. We'll just go down to a 15-minute chart. We actually gapped down, but found support at 11 a.m. and rallied up until the afternoon. But interestingly, unlike the trend for pretty much the whole year, tech was the weakest sector today. Nasdaq up only 0.37%. Actually saw a nice little bounce here in Russell, and a few of the banks as well. We gapped down, we went lower, but then we managed to finish up above yesterday's close. So market and smalls is trying to put in a bit of a technical bottom here on all this volume. So we could get a bit of a bounce up here, but if this was to crack, if we look on a weekly chart, we're just sitting right down there. And if you look on mids and equal weight, I mean, this is the market trying to decide, are we at a little bit of a turn here, a bit of a bottom, or if this opens up, it could be like at the dam wall opening up, because there'll be a lot of people long here, and they'll have their stops down here. And psychologically as well, we've been trying to bottom here, and if that were to break, it could really break hard. And before you know it, we could be back down at the October lows on the equal weight S&P 500. S&P 500 normal one is a different story, because you've got mega cap tech holding that up for now. Okay, moving on, let's just quickly look at the international indices price action there. Much the same, trying to put in a bottom in this oversold territory. DAX holding on a bit better, same as Nikkei, but Aussie down there, and China doing its own thing as always. Volatility actually moved back into a normal contango state, where we've got up the front lower and higher as we go out to 30-day, 3-month, and 6-month. So this market's we haven't had any really bad headlines this week. So for now, the banking crisis seems to have settled a little bit, and we can see that in the volatility markets. But we've still got volatility pretty high up here around 100, and realized volatility, if you just go to a 3-day chart, we hit those real lows down at high 14s. We'll just bounce back up to 18% annualized rate and volatility. And the premium of implied versus realized has come down. So the market kind of caught up with implied volatility, and the equity market, options market's kind of saying, things are okay for now. But the bond market volatility is saying a completely different thing. We've got the MOVE index back at 173. And if you look at the premium, something interesting I wanted to show you today is you look at the premium of the MOVE index over the VIX. We've just moved up to highs, and I'm going to zoom out to a 3-month chart for you. And we're right up here at some of the highest levels it's ever gone. And if I go back down to a monthly chart and we go back to 2008, And you can see we started trending up from the start of 2008 up until mid-2008 to similar levels where we are now. We're actually a little bit higher now. But you can see there was a definite uptrend in this spread towards mid-2008. Now, if I just had the S&P 500 index onto this chart, you can see once that spread between the move and VIX actually peaked and came down, equities came down hard as well. We can all remember GFC, how hard the stock market got hit off, and we didn't bottom down till February, March 2009. And so that spread peaked out just before that big hard sell-off happened. So the bond market is actually better forward-looking than the equity market, and that's because the bond market's made up of much more sophisticated traders that are trading much larger amounts. So I thought that was something really interesting that no one's really talking about, is this move up in the MOVE index versus the VIX. I think that the bond market's telling us something. I don't see how we can have GFC level bond market volatility and GFC level bank borrowing from the Fed and GFC level bank failures, and how that can be a good thing for risk equity sentiment. It's just hard to see how that's bullish for equities. Put call ratio about equal today, same on equity only. So equal amount of calls and puts being purchased out there. Breadth popped up a little bit here today on stocks above their 20-day and 50-day as well. So the market's trying to make a bottom here. All stocks are trying to make a bottom here. 40% of stocks above their 200-day. However, stocks making new highs is still really low. On the big board, just 10 stocks today, 21 on NASDAQ making new highs. And interesting movement in the spreads here today. So we've got the discretionary tech industrials versus defensive health, utilities and staples. That popped up yesterday to a new high, but turned around pretty viciously here today. And we saw a little bounce in equal weight versus SP, and high beta versus low volatility actually came off 2.2% today. And so that's still peaked from February 2nd and has turned down quite big. And it's quite a divergence from growth versus value. So you see growth versus value just actually ripped higher, and then we've kind of put in a bit of a topping pattern there as well. So normally they're correlated, these two spreads, and it's just interesting to see high beta stocks being sold off versus low volatility stocks a lot more than growth versus value. And tech seems to have stalled out a bit here. We're really overbought on tech, and smalls trying to find a bottom here versus bigs, and tech versus smalls. It's such a blown out spread. This could be the start of a bit of a pullback at least, or maybe a reversal. Gold had a bit of a pullback today versus stocks, and yield curves are racing back to positive territory. Another one of our loyal followers every day, Nicholas, actually pointed out to me yesterday that the spread on the 30-year and the 2-year is close to going back to uninverted. And today, that's what it did, believe it or not. We actually got almost 5 basis points above into positive territory. Now, if you go out to a 3-month chart, it's when the yield curve goes back into positive territory after being inverted is when we get the recession and stock markets fall off. So you can see here on the 30-year, 2-year spread, we went inverted then back into positive territory in mid-2007 when things started getting really bad. And same here in late 2000 when we had the bear market there as well. So that's really interesting to see. And this is moving quick. So the bond market could be right, like we are going into recession quicker than we expect from this bank crisis, which is tightening up lending and credit markets really quickly. High yield came off versus treasuries today, and that's really oversold down there. Same with junk bonds versus investment grade bonds, really oversold. And inflation expectations, we can see this in the spread of inflation protected treasuries versus normal treasuries. That has come down a lot since the banking crisis. So the bond market really is expecting this to affect inflation, jobs, and everything else out there that's going to make the Fed have to cut. And 2-year, we got down to new lows today at 355, and pretty much the whole bond complex as well. 10-year still looks to have been trying to put in a hammer formation and bottom around here around 340, but we'll see whether that holds. And treasuries got up again today, 0.42%. And investment grade actually holding on there as well, but not in high yield. High yield still in a downtrend, lower highs and lower lows today. With those lower rates, you would have thought we'd seen a drop in the dollar, but the dollar seems to have popped back up off this support level we've had in here. We had that hammer yesterday, and that's kind of followed through today. So dollar seems to be holding there, maybe a bit of a flight to safety going on along with treasuries. And Bitcoin, we actually got higher today. We made it up to 29,300. Got a feeling we could rip up to 30,000 here, but this could be put in a bit of a topping pattern here for now. It's kind of too hard to say right now. If the dollar keeps acting strong, that's going to kind of put downward pressure on Bitcoin. And with the dollar up, you thought we would have seen commodities off, but they actually managed to hold on here a bit too. And there's copper just kind of sitting up there at that resistance zone. But with those low stockpiles and supply we're seeing, this could be supportive of the copper price. Gold had a little bit of a pullback here today, still sitting up here really high. And silver actually made higher highs and higher lows today. Oil just sitting down here, and we go onto a weekly chart. Just sitting down here really weak. So kind of hard to get bullish on energy names. They've done really well for 2 years. But the energy sector can't break out when you've got oil sitting down here. And just a quick look at agricultural. That had a bit of a good move up there today. And over to stock sectors. So there was a rotation today that we haven't seen in a while. And if you look at semis, they were off the most, 1.5%. And we go out to a monthly chart on the semi ETF. So it's come up to this zone where it's turned before, and it's looking like it's a bit of a topping formation that we put in there today. I'll get to Nvidia and the others in a bit, but there was a definite rotation today, which was interesting. Even though oil was flat, we saw energy and oil and gas pop up, trying to form a bottom down here, like we are on financials. So financials, actually, we gapped down, we made a lower low, but then it held on. There's a bit of a buy the dip. Same with regional. Regional was actually the best performing sector today, but volatility adjusted, it's not much to look into. It was actually up 3% today, and that's a bullish candle formation there. And we do have a little bit of a divergence going on here in financials. So maybe we see a little pop up here and tag the 50 bar, even if they were to fall off again. But we are really oversold here. So a bit of a rotation going on to there. And REITs as well. Big bullish engulfing candle up 2.5%. And utilities up 3.1%. You've been hearing me saying I like utilities down here. I think they are a good buy, especially if we were to even go lower down to October lows. That yield would keep on climbing. And with government rates coming off, the yield differential is favouring utilities. We've had this divergence been going on for a few weeks now. And so that was a big move up in defensive. If you look at that spread of semis coming off 1.5% and utilities up 3.1%, that's like a 4.5% spread. And same with healthcare, got up 1.3 and staples up 1.7. Now definitively over their 50 bar VWAP and on a pretty good divergence here as well. So this is typically what we see going into a bear market or a sell-off, is you see the high growth sectors come off like semis and these defensive sectors as big investors rotate into the safer stuff. So this could be the equity market finally catching up with the bond market and saying there is a recession coming, we want to get more defensive, but still too early to say for sure right now. But the signs are starting to look like that could be the case, because we have had this huge outperformance in semis, growth cyclicals, high beta tech this year versus defensive. So that can't go on forever, especially with what's going on in the banking crisis and the bond market telling us recession's coming soon. So as always, we'll keep an eye on that every day. Subscribe to the channel if you haven't already, and I'll keep you updated on this really important theme going on in the markets. BlackRock came off today, 1%, lower highs, lower lows. JP Morgan as well found new lows today, but there was a bit of a dip buy and a hammer here. So the banks are trying to make a little bit of a technical bottom here. We'll better tell next week whether this is going to hold and we can get a little pop up here or not. Mega cap tech just kind of stalling out, hitting the brakes up here. Apple up in its resistance zone. Same with Microsoft. Amazon not so much, but Google as well. They're all up in those resistance zones that we've had going on here for a while. So they're kind of just stalling out and deciding what to do next. But look at semis. After this huge run we've had up in AMD and Nvidia, we came off today, lower highs, lower lows. And if we just go out to a weekly chart on Nvidia, we can see from its low in October, we've got up 161%. So that's been a huge bounce up in semis. I think they're getting a bit extended up here. We actually took a short position today in First Solar for our clients as well in the portfolio. If we just go out to a weekly chart, this thing has gone up a huge amount from July last year. It's got up 250%. And if we go down onto the daily, we can see there's a bit of divergence here, a hidden divergence. The valuation is crazy as well, 22 billion market cap. Last year it did 2.6 billion in sales, so almost 10x sales. And look at the trend of sales. I mean, 2018 we did 2.2, last year 2.6, so barely even 20% growth over that 5 years. And 2019 was actually higher at 3 billion. And it's, it lost money last quarter as well, it lost 7 million. So it's a great story, obviously a long-term growth industry, but we think it's really stretched up here. And if you look at our stock fair value indicator, we've got it at 117, and our business quality score indicator is actually negative. So we think it's really stretched up here, good risk reward opportunity. And the signal that we really like in this, which I'll show you now, is insider. We've just had the CEO a couple of weeks ago offload $5.5 million worth of stock at $206 a share. And throughout my career, I've just seen it time and time again, how well CEOs and other insiders time their sales. They obviously know the stock better than anyone else, better than any analyst, and they're typically financially savvy people. So he's offloaded here after a big rip up. I'm happy to join his view and think the stock is overvalued and short it. That's not to mean that it can't run against us more, because there's obviously a bit of momentum in the stock price. So we could have to take a bit of heat on this thing and go against us, but we're not going to let it go against us too much. But just looking at that weekly chart and monthly chart as well, we've got the whole candle above our buy-sell band, and we've got a rare bearish 9 count on the monthly chart. The last time we had that was back in 2018, 5 years ago. And then before that we had it in 2014. We almost got a 9 count in 19 and up here in 21. So this thing is super extended technically. And on a valuation basis, we've got the divergence on the daily chart, and we've got the insiders offloading as well. So those confluence of signals got us short here today in our portfolio. So stay tuned in and follow our short on First Solar. And like we said, we're looking for Nvidia. If Nvidia gets up to 300, then we can scale in another short bet on the semiconductors, because there's still a lot of momentum. It's not really a strong topping pattern here on Nvidia. Do have a bit of divergence building. It's super overvalued, obviously, but it's too early to say whether this is topped out. Netflix continued its run from yesterday, tagging the 50-bar VWAP today, just pulled back a little bit at the end. And Tesla, just kind of sitting around there, calling up a bit, indecision around the 50-bar VWAP. This could resolve itself strongly in either direction. I've still got a feeling that direction is down, seeing this big divergence on our hidden divergence indicator. Over to meme stocks today, a little bit of a bump up overall, not too much. Coinbase actually managed to pop up after yesterday, and not too much else to report in the meme space. Here's Deutsche Bank shares today. Came off 8%, got really low. This is actually on the German exchange we're looking at here. But just wanted to show you something, the 3-month chart on Deutsche Bank. And what does this chart remind you of? Let me show you. Credit Suisse, last traded at 85 cents a share. Jim Cramer recommended it right around here. Said it's all fine, don't worry about it. Now he's saying the same thing about Deutsche Bank. So just got the kiss of death from Jim. Doesn't look good. I'd be worried if I was along in that for sure. First Republic, we need to put this on a log chart to actually see what's going on. This thing looks technically dead to me here. I do wish the retail traders in this that are long luck. Hopefully you can get a nice dead cat bounce up to the 50-bar VWAP and get out for a nice pop profit. But whether this goes back to 100 ever again, I'm not sure. I wouldn't bet on it. Same with PacWest as well. They're walking zombies to me. The big guys, they should be fine though, but they're still sliding here. The price action is still sliding. But today we did put on that bit of a bullish 1-2 candle formation, and we do have some divergences building on them as well. Hammer formation there on Citigroup, same with Wells, and a few others as well. Just looking to be trying to put in a short-term technical bottom here. Actually saw First Horizon got up 6%, and there's Zion, KeyCorp, Western Alliance, another one that retail's loading into, and Charles Schwab as well, trying to form a double bottom on a divergence. Okay, so that's a bird's eye view of the market. Let's go back over to SPX. We're at 39.70. Got global net liquidity a little bit higher. Basically, is bang on there. So we've had that Fed inject liquidity. A lot of the banks borrowing from them, keeping the system afloat. And we had the equal weights here come up today, more than the normal SP 500 and on this volume. So this looks like we're trying to put a bottom in here. We're trying to form some sort of bottom. And there'll be a lot of people getting long in here, and their stops will be here, and there'll be all these buy the dips. If this was to not hold, we could sell off viciously, and before you know it, in a couple of days, we're back down to October lows on the equal weight. Because when you get a strong bottom or top formation, and that breaks, it proves to be false. It kind of just makes everyone who's got long here to bail at the same time. And tech, look at tech. It looks to be like it could be topping up here. We hit that resistance line. We sold it viciously on Wednesday, and then we kind of just bounced back and sit in here. Another kind of just little inside bar today. Volatility calling up. We did see semis come off today in a bit of a rotation and defensive. So this could be a turning point here for tech. I mean, it might finally catch up with what the bond market's saying. We're going into a recession. If we go into a recession, typically high growth, high beta, cyclical names will come off hard. Here's the Russell. Same thing, just trying to put in a bottom here on the smalls with the financials. So kind of a key point here for markets. I wouldn't be surprised if we get a little pop up here. But what I'm really watching is for this rotation with tech. And we saw that come off today hard with the high beta versus low volatility down 2.2% on that spread. So I'll be looking for that to continue on. However, do acknowledge the fact that we are putting in what looks to be potential short-term technical bottom. So I had been 100% net short. I used the move down today and some of the tech names to get out of a little bit of shorts and took it back down to 70% net short. So still bullish gold, treasuries, and bearish semis, tech, cyclicals, retail. So that's how I'm positioned for now and going into next week. And we'll see what Monday brings us. Okay, guys, that's all I've got for you this week. I hope you enjoy your weekend. Thanks very much for all your support and all you guys hitting the like button and dropping comments. Really do appreciate it. And I look forward to seeing you again on Monday afternoon. Okay, cheers.